Well, it is a big week for U.S. inflation data. We get the consumer price index on Thursday, then producer prices on Friday. So lots to watch out for. And neither of those are even the U.S. central bank's preferred inflation measure. That's the core personal consumption expenditures price index. In Canada, the Bank of Canada watches multiple different measures of inflation. But what happens if the different data points start to tell different stories? And central bankers pick and choose what to focus on and when. That's a risk, according to our next guest. For more, let's bring in Benjamin Tal, Deputy Chief Economist with CIBC. Benjamin, thanks so much for joining us this afternoon.
It's a pleasure. Thank you.
So there are a lot of different sort of gauges to be watching, but even when it comes to CPI data in this country, there are different measures just within that the Bank of Canada has to consider. Can you kind of break down where we're at with those different gauges?
I don't know. I lost count, because there's so many of them. Life used to be simple. In the 90s, 2000s, they had one measure, core inflation, CPI minus energy, food, and indirect taxes. They look at that and they knew more or less where we are. Then in 2002 or something, they added another one, which was CPI-X, which is CPI minus 8 volatile components, fine. And in 2016, to simplify the process, they added 3 more measures. So now we have medium, we have components, all kinds of other measures. And the point that I'm making is that at any point in time, if you look at how many measures we have, and if you look how we measure it, year over year, month over month, 3 months moving average, 1 month annualized, 3 months annualized, 6 months annualized, all of a sudden you have a buffet of inflations. We have about 30 of them that everybody's looking at. So at any point in time, when we get the CPI numbers, we don't look at one number, we look at 30. And as you said, those 30s are telling you totally different stories. So for example, if the Bank of Canada want to be hawkish, they can focus on core inflation that shows that numbers are above 3%. If they want to be less hawkish, they are looking at numbers that are 2%. What is the real number? Nobody knows, and that's very confusing.
Yeah, that is interesting. And even when you're talking about the Bank of Canada's target range, so the 1 to 3%, but really the 2% is the target. Is that for core or is that for the headline CPI?
Actually, it's for the headline CPI. That includes everything. That's their focus. The focus is 1 to 3 for the headline CPI. But they know that the headline CPI can be very, very volatile because of gasoline prices, energy prices, food prices that dance to all kinds of tunes. And therefore, they say, let's focus on something that is not volatile. So they started with core, they moved to CPI-X, and now to those 3 measures. Now, those 3 measures that they were talking about, which was the medium CPI and the other components of CPI, they were behaving well over the past few years until COVID. When we are 2021, all of a sudden they started moving in different directions, and the Bank of Canada had to decide, okay, are we choosing this one or this one or this one? And one of the reasons why they made this mistake, assuming that inflation was temporary, remember that, is because of the fact that they focused on the wrong measure. This wrong measure basically was consistently below 2%, while other measures were above 2%, and they say, don't listen to the other ones, let's focus on this one. That's the problem when you have a buffet of CPIs and you can choose whatever you want. So the risk here, and that's important, the risk here is that the narrative will determine the story, not the data. And that's risky.
So do you think that the Bank of Canada is looking at the incorrect ones right now, and painting a picture that it wants to see versus the one that you think, is more of a true reflection of going on? Or are you just concerned about that possibility?
Yeah, we discussed in the past. I don't like the fact, for example, that interest mortgage payments are part of the calculation. And that's something that is biasing the picture. If you take them out of the story, all of a sudden inflation looks much better. So there is another element to this inflation story that we are not even talking about, but it's important. I think that when you have too many choices, the message is very confusing. I don't think that it's necessary to have all those model-based measures. I think that you can go back to core or CPI-X and finish there. Keep it simple so you know what you're focusing on. And more importantly, the market knows what you're focusing on. And you have one story. When you have 30 stories, nobody knows what you're following, and that's very confusing.
So when we get the next inflation print for Canada, that's not until next week, but what will you be focused in on, Benjamin?
I will focus on service inflation minus shelter. That's what the Bank of Canada is focusing on now. That's the new inflation du jour, if you wish. And that's something that we have to focus on because the Bank of Canada is focusing on. Another factor, I will look at the mortgage interest payments and see how much they're adding to inflation, because you can make the point that at one point, the Bank of Canada will say, listen, look at inflation in the US. It's very similar to Canada, but the difference is that in Canada, we have mortgage interest payments. In the US, they don't have it. So they will have to take this into account. So I would focus on service minus shelter and interest mortgage payments and how much they're adding to overall inflation.